We want to take you now to Washington. You see right there, Fed Reserve Chair Janet Yellen is speaking. This is after the Fed raised its benchmark interest rate. The number affects what you pay on everything from credit cards to mortgages. And this is also Yellen's last news conference as Fed chair. So let's listen in.
With the maximum employment and price stability objectives assigned to us by law. Before saying more about our decision, I'll review recent economic developments and the outlook. Following a slowdown in the first quarter, economic growth stepped up to a solid 3.25% pace in the second and third quarters of the year. Household spending has been expanding at a moderate rate, business investment has picked up, and favorable economic conditions abroad have supported exports. Overall, we continue to expect that the economy will expand at a moderate pace. While changes in tax policy will likely provide some lift to economic activity in coming years, the magnitude and timing of the macroeconomic effects of any tax package remain uncertain. Smoothing through hurricane-related fluctuations, job gains averaged 170,000 per month over the 3 months ending in November, well above estimates of the pace necessary to absorb new entrants to the labor force. The unemployment rate has declined further in recent months, and at 4.1% in November was modestly below the median of FOMC participants' estimates of its longer-run normal level. Broader measures of labor market utilization have also continued to strengthen. Participation in the labor force has changed little on net over the past 4 years. Given the underlying downward trend in participation, stemming largely from the aging of the U.S. population, a relatively steady participation rate is a further sign of improved conditions in the labor market. We expect that the job market will remain strong in the years ahead. You may have noticed that we altered the statement language about the labor market outlook. This change highlights that the committee expects the labor market to remain strong, with sustained job creation, ample opportunities for workers, and rising wages. We anticipate some further strengthening in labor market conditions in the months ahead. However, we expect the pace of job gains to moderate over time as we gradually reduce the degree of monetary policy accommodation. Allowing the labor market to overheat would raise the risk that monetary policy would need to tighten abruptly at a later stage, jeopardizing the economic expansion. Even with a firming of economic growth and a stronger labor market, inflation has continued to run below the FOMC's 2% longer-run objective.
We've been listening in to Fed Chair there, Janet Yellen, speaking about Fed raising their benchmark interest rate. I want to bring in Scott Gamm. He's a markets correspondent with The Street TV. He joins me now by phone. Scott, what do you make of this rate hike?
Well, look, it was as expected. We went into this meeting with a 98% chance of a rate hike. This is the Federal Reserve's 5th rate hike since the 2008 recession. It's their 3rd rate hike so far this year. It's an endorsement of where we are in the economy. It means that the economy can stand on its own 2 feet without as much support from the Fed. And the Fed is also expecting 3 more rate hikes in 2018, which was also in line with what the market was expecting.
So the fact that the Fed seems to think that the U.S. economy is in good shape, you expect that trend to continue in 2018?
Yeah, I do. I mean, look, there will be some uncertainty just in the sense that Janet Yellen is stepping down as Fed chair starting in February. Jerome Powell is set to succeed her, and he's a little bit different in the sense that he's not an academic like Janet Yellen is, and as previous Fed chairs have been. He's more of a markets person. He worked at the Carlyle Group, so he could bring a little bit of a different dynamic to the Fed, but ultimately I don't think any Fed chair wants to shock the markets, and I think that's the main takeaway for investors, more of the same.
We see the markets up. What's the sense? What are you, as someone who watches the markets, looking for in the coming new year? And if there is not a tax plan passed by the end of the year, how do you think that's going to affect the markets?
Well, look, it'll be very interesting to see what the tax reform bill does to the markets. There's been this whole debate so far this year as to how much of the gains we've had have been attributed to tax reform versus earnings growth. And I think a lot of the strategists are more saying that the market has risen because of earnings growth. So do we give up some gains if we don't get tax reform? That certainly is a possibility. But, Goldman Sachs is only expecting the tax cuts to add 0.3 percentage points to GDP in 2018 and 2019. So, if the economy does start to heat up a little bit, expect the Fed to be a little bit more aggressive in the coming years.
So if you hold a mortgage rate, you've got credit card debt, what does this mean for you, Scott?
Well, that's a great question, because traditionally, when we see the Fed raise interest rates, that should trickle down to consumers via higher interest rates on mortgages, credit cards. But we've actually been seeing the opposite. If you look at the Goldman Sachs Financial Conditions Index, which measures how easily credit flows through the system, it's actually at a 3-year low. That's before the Fed's initial rate hike back in 2015. So the Fed is trying to tighten policy, normalize policy, but financial conditions are actually easing, and it's a fascinating dynamic, and it really shows that the markets aren't really buying the Fed's plans here. The markets are a little bit more cautious than the Fed.
Scott Gamm, thank you so much for joining us, Scott.
Thank you, Rena.
And we're going to have much more news after the break. You're watching CBSN.